Today, we're diving into a question that sparks a lot of debate every time that I bring it up. How soon could a pharmacist save $1 million? And is it possible that a pharmacist could save $1 million by the age of 40? Now, if you just had a reaction to that as you heard it, maybe excitement, maybe skepticism, maybe even a little frustration, that's worth paying attention to. Because often our gut reaction to questions like this can reveal something about our money beliefs, beliefs that may be helping us move forward or beliefs that could be holding us back. So let's unpack it. We'll look at the math, the mindset, and I'll share some of my own story of going from a negative $225,000 in net worth after finishing residency in 2009 to crossing the seven-figure mark. Now, let's begin with the numbers. All right, here's the short version. If you're in a hurry, can't listen to the full episode. A pharmacist in their mid-20s, saving around 30% of their income, could realistically cross the $1 million mark by the age of 40. Now, of course, this is not guaranteed. Of course, it's not investment advice. There are a lot of assumptions that go into these numbers. But let's look at this example a little bit further, right? Let me say it again. A pharmacist in their mid-20s, saving around 30% of their income, could realistically cross the $1 million mark by the age of 40. Now, you can apply this timeline at any point in your career. So if you're listening and you're in your mid-40s, right, we're talking really about a 15-year time span of investing. Now, if we break this down further, a compound interest calculator, and if you want to play around with this further, we've got one of those on our website. We'll link to it in the show notes. A compound interest savings calculator tells us that if someone is saving about $3,200 a month, so roughly 30% of their income, over 15 years at a 7% average annual rate of return, that will yield about $1 million, actually just shy of $1 million. Now, that's it, right? That's the math. Now, I know a lot of you are saying, well, what about $3,200 a month? What about 7% rate of return? The market doesn't work like that. There's a lot of volatility, of course, but just stay with me as we talk about this from a broad view, right? What we're trying to focus on is not the nuances of a 7% versus a 6% or the type of investment, but just generally speaking, is it feasible that we could save a fairly significant chunk of money in a reasonable period of time, right? We're here talking about a 15-year period. Now, while that's it, that's the math, the question becomes, is saving $3,200 a month realistic? I would argue that not for everyone, but for many pharmacists, it may be. And it really depends on what else is going on in the financial plan. What part of the country do you live in? What's your household income, right? A lot of different factors to consider. But if we break it down, looking at someone who's earning $130,000 a year, and if we assume they have a 4% employer match on whether it be a 401k, if they work for a for-profit, or a 403b, if they work for a nonprofit, you can start to see how the math would add up to that $3,200 a month, right? If someone's making that $130,000 with a 4% match from their employer, the employer match would allow for $10,400 per year. That's $5,200 from the employee, $5,200 from the employer. If they were then to max out the rest of that employer account, so remember the annual limit here in 2025 is $23,500 per year. That does not include any employer match. So if you were to put in another $18,300, that would get you to that maximum amount per year. If we were then to say max out a Roth IRA, again, not investment advice, just an example, that's $7,000 per year. And let's say we top it off by putting about $2,700 a year in a brokerage account. You put those together, the employer match, the filling up the bucket by maxing out the employer retirement plan, the Roth IRA, and the brokerage account, that adds up to about 30% of gross income. Ambitious? Yeah, it is. Impossible? I don't think it is, right? And here's where it gets fun. The rule of 72 tells us that at a 7% rate of return, your money would double about every 10 years, which would mean if we play out this example, right, $1 million at 40, we would then have what? 2 million at 50, 4 million at 60, 8 million at 70. That's the power of starting early and letting time value of money and compound interest work its magic. Now, some of you, I suspect, are listening and asking, or maybe you're yelling out loud at me as you listen, but what about my $200,000 in student loan debt? What about my childcare costs? What about my housing expenses? How is this realistic? And these are all fair questions. But notice these aren't just math problems. They do have a math component for sure, but they're also mindset problems. They're cues to some of the limiting beliefs that we can have. Who said that our income was fixed? Who said that expenses couldn't be adjusted or optimized? Who said that you couldn't get creative with the income side of the financial plan in addition to looking at some of the fixed costs, right? The math is simple. The harder part is the execution. Now, I want to share a little bit about my story here as just one example and kind of what I learned through that journey and how you might apply this as well to your own. When I graduated from pharmacy school in 2008, finished my residency in 2009, I finally had hit that six-figure salary mark that I had been hearing all about while I was in pharmacy school from 2002 to 2008. And while that was a cool achievement, right underneath the surface, it really felt like we were broke, but high income earner broke, or relatively high income earner broke, right? We had over $200,000 in student loan debt. We had a house with almost no equity. We had very little in savings, and we had a growing family to support over time. So despite earning a good income, now we can argue about the pharmacist income. Is it still a good income? I would say objectively speaking, it is. If you look at the median pharmacist income, about in the mid 130s right now, obviously depending on what part of the country you live in, that may go further some than others. But the median household income in the United States has been hovering around $80,000. So pharmacists alone, on average, are making about $50,000 above the average household income in the U.S. So objectively speaking, it is still a good income. How good, right? That's where the debate lies. But despite earning that good income, we had a negative net worth of $225,000. Now, I've talked about net worth on the show many times, so I'm not going to dig deeper there. But that was just a few years out of school. And it was frustrating because it felt like we had done everything right. But the turning point really came in 2012 when I read the book, The Millionaire Next Door. That book really hit me upside the head with a simple truth that is critical to understand with the financial plan. Your income, while a great tool, your income doesn't measure financial health. Rather, your net worth, assets minus liabilities, does, because it measures what sticks from how that income is used. So from that mindset shift, Jess and I really made a pivot. We got serious. We paid off our student loans in 2015. We made a lot of mistakes in that journey that I've shared before on the show as well. We made it harder than it needed to be, but we got the job done. And once we crossed from that negative net worth to zero, we began to go on the offense. Through consistent saving, through investing, through diligent planning, eventually starting a business, we went from negative $225,000 to crossing that seven-figure mark with a net worth in 2020, about an 8-year period. And one of the cool things is I look back on that journey, we didn't get there because of fancy spreadsheets. Yeah, I like to nerd out in a spreadsheet from time to time, but we didn't get there from risky investments. We didn't get there from day trading. We didn't get there from living on rice and beans. Sure, there was a period of making sacrifice, but we've enjoyed our life along the way as well. We got there because of consistency. We got there because of clarity, and we got there because of community and surrounding ourselves with others that were challenging themselves as well. And let me be clear, we made a lot of mistakes along the way, many of which I've talked about on the show, right? So it wasn't perfect. As I look back, there was a lot we could have done differently. But ultimately, it was just like we see as we think about the markets trending up, right? Like over time, it's up and to the right, but from time to time, you might take a step backwards, right? And that was very much our journey as well. So what does it take to move from the idea of saving $1 million, whether it's by the age of 40 or 50 or 55? What's it take to actually begin to execute? There are 5 strategies that really, I think, were instrumental for Jess and I that I want to share with you as well, that will help you with the momentum, with the progress, in addition to just the math that we already talked about, right? Simply saving consistently over a long period of time. Number 1 is, if you're not already doing it, track your net worth. Again, your income is a tool. It's a great tool for many pharmacists, right? But your net worth measures what actually sticks. That's the real scorecard. That's the real financial measurement. What we talk about in the book, Seven Figure Pharmacist, right? Your net worth is the vitals check. Where are we at financially? Are we progressing in the right direction? Number 2 is set up and automate your savings buckets. So define your goals, automate your contributions, and give every single dollar you earn, regardless of the income that you earn, how big or how small it is. Thinking about those that might be in residency or fellowship where it can feel frustrating in that season. Regardless of the income, we want to be intentional and we want to automate our savings and working towards those goals. Number 3 is that we have to play defense. Right here, we're talking about the offensive side of the financial plan in terms of saving and building wealth or beginning to build wealth. But we also have to make sure that we organize our financial plan. So it's not just about building wealth, but it's about protecting it as well, right? Things like appropriate life insurance, disability insurance, estate planning documents, emergency funds, all of that would fall here in this bucket of playing defense. And again, as I mentioned on the show last week, and I've talked about many times, don't underestimate the peace of mind that this can give you that will allow you to take some of the calculated risks. Number 4 is making a consistent commitment to increase your financial IQ, learn the basics, or at least the basics, if not more, of investing, insurance, tax planning, debt management, all types of things that we can consider here. A little knowledge goes certainly a long way. And then number 5, just respecting and on some level being in awe of the power of compound interest, understanding that small, consistent choices add up over time to really make a radical difference. It doesn't feel like it in the moment, but it certainly does as you start to see that exponential growth with your investments. So those 5 things: track your net worth, set up and automate your savings buckets, play defense, increase your financial IQ, and respect the power of compound interest are really going to help with the trajectory of building your long-term savings goals. So back to our original question: can a pharmacist save $1 million within a relatively short period of time, right? 15 years. So whether that's 40, 45, or 50, whatever the age is, can a pharmacist save $1 million? The answer is yes, it's possible. Many pharmacists have done it. The math isn't complicated. The challenge isn't the knowledge. The challenge is setting and sticking with a plan. And here's the bigger question that we need to think about, right? It's not really about the $1 million. It's about what that money represents. For many people, that might be freedom. It might be options. It might be the ability to live your rich life. It might be the being in a position to give, or several of those things. Not just someday, but today, right? So what does that money, what does that goal represent? Because if we're just chasing the dollar amount, I think inevitably we'll wake up someday and say, what was the purpose? What was the point? So here's my encouragement to you as we wrap up. Don't get caught up in whether you're ahead or you're behind or you're right on track compared to some benchmark. Focus on building your plan, build consistency, and over time, see the momentum of that consistency. Because to be frank, as I look back on my own journey in 2008, 2009, right now about 17, 18 years ago, when we were starting significantly in the hole, I wouldn't have believed that number of 1 million or 2 million or whatever would be that number in the future would ever be possible. It's about implementing the behaviors, building that foundation that you can grow from over time.